macro market trends, stock selection, ETFs, options, just some of the topics covered in Tactical Trading. Well, just 2 weeks ago, Kevin Cook, our tactical trader, told us that the bottom was not in the stock market. Let's see what he has to say now as he returns after yesterday's wild ride in the stock market. Mr. Cook, we had a situation there where we came close to your S&P target of 1050, but then a powerful reversal. What happened?
Yeah, an amazing rally on Tuesday there. Brought us all the way back. So let's take a look at the chart and see what's evolved. This is actually a chart I showed you about 3 weeks ago. This bear flag, this formation here where the market is making higher lows and higher highs, but in this consolidation congestion channel, sort of a staging area, and market technicians would say this is the staging area to go lower. We cracked it once, then we still rallied back up to 1200, and that's when 2 weeks ago I said the bottom is still not in. And finally, we crashed through it, starting late last week, into Monday, Tuesday, S&P below 1075, and then this powerful late day rally, like in the last hour of the day. Obviously money managers came in, they saw bargains, they're looking around going, it's not that bad, both economically, we don't see that we're getting the data that spells recession is around the corner, and the selling doesn't appear to be that bad. You have to realize that money managers and traders are also looking at the price action that day too. Even though they have a 6-month forecast for stocks and the economy, they're also going, fear isn't really taking over here. So I think that from here, based on the powerful rally that we had yesterday to take the S&P down to 1075, back above 1125, that we could have another rally here. Maybe that takes us all the way to 1200 again on the S&P. But we're still digesting the data, and we don't know how close we could be to a recession. Most money managers, though, if their forecast is for slow growth, maybe 1% GDP growth, they're still going to be buyers of stocks because they're not going to go to cash.
So just to clarify, you're saying that was not the bottom?
I think there's a better than 50% chance that it was the bottom, but it will probably need to be tested. So we could see S&P 1050 again after this rally is over.
Okay. You follow the VIX indicator for volatility. What's that telling you right now?
Yeah, so let's take a look at the VIX. So here we are hovering in this area between 30 and 45. And you'll notice this week we went as high, we didn't even touch the old highs from early August when the VIX got to 48. We got up to, say, just above 47. And obviously when the market rallies, fear subsides, the VIX comes back down. But I want to clarify exactly what the VIX is. Remember, this is an indicator that measures options volatility on the S&P 500. So the VIX is derived from, there's something called the SPX that trades at the Chicago Board Options Exchange, which is the S&P 500 index options.
Right.
And those puts and calls, the prices that are being paid for those puts and calls determines what the volatility is, right?
Right.
So obviously, when we talk about the VIX spiking, it means that institutional money managers are paying more for protection. They're buying up puts because they don't want to sell their stocks. They don't want to take the tax implication for selling their stocks. They don't want to give up the dividends. So instead, they buy insurance. How do they do that? They buy puts on the S&P 500. So, and the VIX is telling you how much are they paying. So when the VIX soars, they're paying a lot more for insurance because they're worried. Now the question is we're stuck here in this range between 30 and 45. Is this indicative of high fear? And it's actually, it's a little bit simpler than that. Now remember, as I point out here, the VIX at 40, is annualized standard deviations. Just like, when you took statistics class in college.
Which I never did because I couldn't pronounce it either.
Volatility is just annualized standard deviation. So what it implies, the VIX at 40 implies that the market could be 40% higher or lower 1 year from now about 68% of the time, which is what one standard deviation is.
So is this all just probability and statistics?
It is in a sense, right? But it's also the way that options market makers have to price risk. You can think of the VIX as the price of risk, right? And the price of risk got a little bit higher since the market has melted down, and these option market makers have to be careful. So it's crazy sometimes to talk about, well, if the VIX is at 40, and that's telling us we could be 40% higher or lower 1 year from now, what good does that really do me? When the VIX, during the financial crisis in 2008, when the VIX got up to 80, was that implying the market could be 80% higher or lower 1 year from now? Doesn't seem to make sense. So what I did is I'm gonna show you something here. Let's break the VIX down into a one-day calculation.
All right.
And the way you do that is because the VIX volatility, vol for short, is proportional to the square root of time. Mathematical concept. I'm not a math guy, but I understand this. What you do then is you can divide by the square root of a given time period and come up with a daily volatility. So I've done an example here. 40% volatility. We're going to divide by the square root of the number of trading days. There's about 256 trading days in the year. The square root of 200, there's about 250 trading days, you could say. Well, it just so happens that the square root of 256 is 16. 40 divided by 16 gives you 2.5%. That means the VIX at 40 is pricing in that the S&P could move 2.5% in a single day. Now that's a big move, a 2.5% move up or down. But that's how the VIX works, and that's what options market makers have to protect themselves against. If they're selling puts or calls or buying them, they're saying, hey, the way this market is moving, we're making at least 2% moves every day in these big swings. Now, so as you see the VIX creep up, that means the price of risk just got higher. The VIX goes to 50, they're starting to price in 3% moves per day. When the VIX is at 80, that's pricing in a 5% move every day for, say a period of a couple of weeks. So this is how the VIX works. And again, it's just the way the options market makers have to price their risk.
Okay. A little bit of education there from our tactical trader, Kevin Cook. You can follow him, his column anyway, on Zacks.com. And that column is always interesting, changes frequently, so you may want to check in more than just once a week. Or you can follow him on Twitter at Kevin B. Cook. And with Kevin, I'm Terry Ruffalo.